Let's talk SoFi here. Getting hit, down 11%, 6-month lows. I mean, barely hanging on. What's up?
You know, this one's interesting because it was a beat and raise when it comes to the full year outlook, but I think it's the second quarter outlook that's really weighing on shares today. As you said, down about 10.6%, despite actually boosting that full year outlook. Running through the numbers before we get to guidance, adjusted EPS of 2 cents. Topped analyst expectations by a penny. The expectation was for a cent. That was the second straight quarter of profitability there. Revenue, meanwhile, came in at $580.65 million. The expectation was for $567.12, so that also was a beat. Total deposits were up 16% in the first quarter to $21.6 billion. SoFi, of course, has three segments: lending, which of course includes student, personal, home loans, the financial services segment, and then they also have their technology platform. So when you take a look at lending, student loan originations rose 43% to $752 million. Home loan originations surged 274% to $336 million. But then personal loan originations rose 11%, so much more modest, to $3.3 billion. They said that growth was actually more muted, and that was expected given their more conservative approach in light of macroeconomic uncertainty, which I think is pretty telling there. Now, in terms looking ahead, they said 2024 is a transitional year because the tech platform and the financial services segments together are expected to drive growth, that growth to increase from 38% of total adjusted net revenue in 2023 to approximately 50% in 2024. In terms of the outlook, I mentioned that it was mixed. For the second quarter, they're expecting it to come in, net revenues to come in at $555 million to $565 million. Well, Wall Street was expecting $581 million, so disappointing there. But then for the full year, they're forecasting adjusted net revenue of $2.39 to $2.43 billion. The prior range was $2.365 to $2.405. That also topped analyst expectations of $2.376 billion. Lots of numbers after the decimal point there. Also forecasting earnings per share of 8 to 9 cents. Previous expectation was for 7 to 8 cents. Wall Street expecting 8 cents. So boosting for the full year. Assuming that lending revenue will be 92 to 95% of the prior year's level. Important to note that. But shares, definitely, investors seem to be focused on that disappointing Q2 outlook because shares down, 10.5% right now.
SoFi just reported its 2024 Q1 results, and funnily enough, investors already had an idea of what to expect, thanks to a recent post CEO Anthony Noto made on X, where he used the phrase, "my 2 cents." This led many investors to think that he was hinting at an EPS of 2 cents, while others said that it was just a common phrase and he wasn't actually hinting at anything. But it turned out that the first team was right, as SoFi's diluted EPS came at 2 cents, beating Wall Street's call of 1 cent, and the company's overall results were great, marking its second quarter of profitability. Not only that, but SoFi managed to top revenue estimates and boost its fiscal year guidance. And yet, despite these amazing results and massive estimate beats, SoFi stock fell more than 10% following earnings. In this video, we're going to explain why that happened by walking you through SoFi's earnings report and what these numbers mean for the bank and investors. But before we do that, if you want to keep up with SoFi's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Joining us now exclusively is SoFi CEO Anthony Noto. Anthony, welcome back. Good to see you.
Good to see you as well.
So why is the stock down 9% despite a strong increase to guide? What is the street taking from this?
Yeah, I think it's important to focus on the results and what that means for the full year and then what that means for our 3-year outlook. So in the quarter, we achieved 26% year-over-year growth in revenue, $581 million. We had 25% EBITDA margins. We grew that almost 100% at $144 million. More importantly, we have grown tangible book value per share 16% sequentially by about $600 million. We had record deposits of $3 billion and really strong overall performance. The most important thing about those trends that I'd point out, and the reason why 2024 is a transition year, is the growth was driven by low capital, high return businesses, our technology platform business, and our financial services businesses. Those two businesses, when combined, grew 54% year over year against lending that was flat. As we came into 2024, given the uncertainty in rates and the economy, as well as liquidity for the industry, not us, and despite having excess capital, we made a decision to put the resources behind these high return businesses that actually are big enough now to drive our overall growth and profitable enough to do that. And so that's the key message coming out of the quarter, is that transition is taking place and going incredibly well, which sets us up for a great 2024. We actually raised 24 revenue guidance by more than our beat. The comparison to Q2, we'd not provided Q2 guidance before. The street had an estimate there that was above what we guided to, but for the full year, estimates will be going up relative to consensus by more than our beat in Q1.
Looking at SoFi's Q1 results, we can see that total adjusted net revenue hit $581 million, representing 26% year-over-year growth. Not only that, but it beat analysts' expectations of $555 million. Meanwhile, net income for the quarter came in at $88 million, significantly beating estimates of $15 million. It's also a huge improvement from last year's $34 million loss for the same quarter. Additionally, the company's total deposits grew by a record of $3 billion, up 16% during the first quarter to $21.6 billion at quarter end, with over 90% of SoFi Money deposits, which are inclusive of checking, savings, and cash management accounts, coming from direct deposit members. Another positive thing SoFi reported was the increase of Galileo accounts, as the platform added around 6 million new accounts in the quarter. The bank also added 622,000 members and around 989,000 new products, bringing the total to 11.8 million. Now, why did the stock drop if the earnings were so strong? Let's talk about it. We'll also talk about where the company is headed next, so keep watching and don't miss out. Hello everyone, and welcome back to Investocracy.
SoFi Technologies, that one, despite posting a better than expected earnings for the first quarter, shares tumbling, more than 10% today after a disappointing outlook for the second quarter. Quentin, what do you make of SoFi here?
Yeah, Leslie, this is a tough one because I really would love to get behind this company. We've traded it in the past, and I've tried to really buy into the idea that it's more than a bank. But at the end of the day, today's price action tells you all you need to know. They beat on top and bottom, and they raised guidance. But the bottom line is it's still a bank, and it trades pretty rich, 1.3 times book, which is traditionally the way banks will trade. I'll give them the extra, value due to having some increased technology and growing their user base. But at the end of the day, it's still a bank. And unfortunately, at these levels, it's just not for me. So I'm not a SoFi owner, and I'd sell the stock, unfortunately.
As of the time of this video, SoFi stock is down by around 26% since the beginning of the year, and right after the company reported earnings, it actually rose by around 7%. So, investors were left scratching their heads when the stock fell more than 10% after earnings, but the reason for this becomes clear when you look at SoFi's guidance for this year's second quarter. For its second quarter, SoFi said that it forecasts adjusted net revenue of $555 million to $565 million, which came way below analysts' expectations of $581 million. This obviously disappointed investors, and many chose to just take profits after the initial jump in the price, expecting quarter two earnings to be bad thanks to SoFi's forecast. Now, there are multiple reasons why SoFi put out a disappointing guidance, and one of them is actually the fact that its high net income for this quarter was probably a one-time thing. In the report, the company said that its $88 million net income was a one-time benefit from exchanging convertible debt of $59.2 million. So without this one-time benefit, net income is actually around $29 million. As for the other reasons behind the market's reaction to the stock, let's hear from CEO Anthony Noto himself. But before that, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, Back to the video.
That allowed us to redeem a preferred security that we were paying 12.5% interest on. So that is going to provide an interest savings for us. And we've already noticed all of the holders of that preferred instrument. And so that's being redeemed sooner than expected. We also bought back an existing convert that was trading well below its face value. And that was accretive to book value. And it was basically neutral on tangible book value per share. So there's some perception that it was dilutive. It's not dilutive on a tangible book value per share. I think there's just a misunderstanding on what the total ending share count will be in the future.
My colleague at Bloomberg Intelligence, Herman Chan, has a very clear thesis for you guys. You have a brilliant app, strong user interface, one-stop shop, and you're targeting young professionals. That's what they think. But the story really is this higher interest rates for longer environment narrative. How does that thesis work in that rate environment, Anthony?
Yeah, well, first of all, your colleague said it very well, and so we should consider having them being one of our spokespeople. But what I'd say is higher for longer is going to create challenges for financial institutions. We are very well capitalized. We have a 17.1% risk-based capital ratio, so we have ample cushion in our capital ratio relative to where we have to operate from a regulatory standpoint, and we have plenty of liquidity. That said, as we saw today, another regional bank was really challenged. We're also benefiting from really strong deposit growth. We had a record growth in deposits, $3 billion of new deposits, and 90% of our deposits are from direct deposit customers, which means we're their primary account, and it's very, very sticky. But a higher for longer will put stress on other people's balance sheets if they're not hedging appropriately the way we do. We hedge our loans once we grant them, so we don't have that interest rate exposure. We can also match what we're giving as an APY to our SoFi Money members against the loans that we're offering and the rates that they have to maintain a very high NIM, and we've been able to do that consistently. In addition to that, we also have the tech platform business, which is not tied to interest rates. And then in the financial services business, we have the Invest platform that's growing very nicely, good AUM growth, good member growth, and another source of diversified revenue for us.
I want to bring our audience that macro flavor that you so brilliantly give, because why are you more cautious on the US economy? Why are you seeing 5% excess of unemployment? Why are you seeing these interest rate cuts that you've now basically halved in your expectations for 2024?
Yeah, our balance sheet has grown quite meaningfully. It's about a $30 billion balance sheet now. So as we came into 2024, we had a choice. Could we come up with our own expectations for 2024? Could we use consensus expectation? Let's just take a planning stance that's really conservative. And the planning stance that we took then was that there would only be 4 rate cuts. The market was factoring in 6 rate cuts at the time. We also took a planning stance on unemployment that would be more than 5%. The market was well below that. And we also took a stance on GDP contraction that was modest. Well, here we sit today, 3 months later, and the market's only factoring in 1 to 2 rate cuts. So I'm really thankful we took a conservative stance going into the year, and I'm really thankful we still have a conservative stance. I couldn't feel better about the underlying trends of our strategy and execution of our business, but I don't think we're in an environment where anyone has a really strong, high conviction level on where rates will be. There's still a debate whether there'll be any rate cuts whatsoever. So we just can't put the business at risk, hoping that we can figure it out. So we're going to a conservative point of view.
Now, what's next for SoFi stock? And should investors buy now? Even though the company's Q2 guidance disappointed investors, SoFi still upgraded its full-year forecast, which indicates that its outlook for the full year is positive, and this could mean that the rest of 2024 will continue to be a great year for SoFi stock investors. For the full year, the company forecasts adjusted net revenue of $2.39 billion to $2.43 billion, higher than a prior range of $2.36 billion to $2.40 billion. It also forecast earnings per share of 8 to 9 cents per share, above the previous call of 7 to 8 cents. These are extremely strong forecasts by the company, and given that SoFi hit the forecast of achieving bottom-line profitability in Q4 of 2023 and Q1 of this year, there's no reason to think that SoFi won't be able to achieve all of this. Compared to analysts' expectations, SoFi's forecasts are a bit more ambitious, as analysts expect revenue of $2.37 billion and an EPS of 8 cents. SoFi is being conservative with its Q2 forecast thanks to macro environments and uncertainties about the interest rate cuts, and investors already knew that lending revenues will be lower this year, as SoFi said in its 2023 Q4 results that lending revenue will be 92% to 95% of the year prior's level. In its earnings release, the company said that 2024 remains a transitional year for SoFi as the tech platform and financial services segments together are expected to drive growth and increase from 38% of total adjusted net revenue in 2023 to approximately 50% for the full year of 2024, which is still incredible news for the company. In my opinion, the drop in SoFi stock after earnings was just an overreaction from the market. There's nothing really wrong with the company itself, as it beat all estimations, and the reason why it's forecasting lower revenues is because it's choosing not to go so aggressive on lending in an uncertain interest rates environment. Once we have a better idea on what the Federal Reserve plans to do with the rates, SoFi will adjust its strategy accordingly, so there's no need to worry about SoFi's full-year performance or its long-term growth prospects. SoFi is expecting a lot from its tech platform and financial services segments, and if you take a look at the company's financial statements and compare the revenues and expenses of these segments, you'd see that tech platform revenue is up by 21% year over year, while expenses are up only 1% year over year. Similarly, financial services revenue is up 86% year over year, while its expenses are up only 8% year over year. This is great on SoFi's part, because its fastest-growing services don't have very high costs. Keep in mind that this isn't a stock for investors who aren't willing to buy and hold for the long term, but for those who are, SoFi stock could be a golden investment opportunity for the company's forward-looking thinking and technology advancements. But what are your thoughts, though? What do you think about SoFi's Q1 earnings? Did you buy SoFi shares before earnings were reported? Are you planning to buy more? Let us know in the comment section. If you would like to know more about the latest updates about SoFi and other companies like it, then go ahead and click on the next video on your screen. See you there.